Hello everybody. So today more of an unstructured video. I want to talk about some moves I'm making in my portfolio, and namely I'm going to be adding to HIMS, adding to Shift4, and I'm going to be selling PayPal. And I'll show you kind of the trade-off between why I prefer say a 4 over a PayPal in a second. But first, let me start with HIMS. So with HIMS, the stock is back at the level that it was prior to them posting their outstanding Q1 2024. I was very pleased with the results. We've heard everything we wanted to hear, including the fact they were launching GLP-1 type based drugs that were going to be chemical compound, compound based, but they're going to be entering that GLP-1 narrative this year. We've heard that from the CEO of HIMS, and the growth of HIMS is still growing at 40 plus %, and they have reached their guidance that they had guided for the end of 25. They've already reached it today, so more than a year, well over a year in my view, well over a year early, they've reached their guidance. So this is a company that is still growing stellarly. There's no other way. It has stellar revenue growth, and if you look at the revenue growth, it hasn't hit a bump in any way. This is ever since they did their SPAC. This is the revenue growth that they posted. You can see we are right entering that S-curve. We're in the middle of that S-curve, maybe the beginning of the S-curve, but there's a clear S-curve that is being outlined. And this is a company that is profitable. They have GAAP net income, but they also have EBITDA margin, which obviously they do. Well, obviously they would, but the EBITDA margin is what I look at on this channel. I don't really look at GAAP. I think EBITDA margin is a much better calculation of whether if a business is profitable, especially for a business like HIMS, which is more of a SaaS type business. So that EBITDA margin is 11%. And we know they've guided up to 30% EBITDA margin long term. Their 2029 target is close to 30% EBITDA margin. And who knows how quick they're going to be able to be growing. But they have so many more products coming in store, more than just ED and air loss. It's very reductive to just say this is what this company sells when they sell so many more products. And this is yet an example of the stock really not making any sense. If you map out the stock, you're about there. The stock actually did like a whole U. If you look at the IPO, the stock is in a U shape, and it's in a recovery towards the $20 ish pricing that we saw post SPAC. The stock, frankly, the price movement, the stock price movement is seemingly very unrelated to the underlying performance, which is why for me it's a very long-term hold. I would not consider owning this stock for just a few months or for just a year, because who knows if it goes back to 7 or 8. It may. Nobody really knows. When you buy stocks that are this small, you have to be comfortable with volatility, which I obviously am, as evidenced by the assets that I cover on the channel. If you've been following the channel, you know that volatility should be my middle name. I'm very used to that, and most of you, I assume, who watch this channel are very used to volatility. And so that's okay. Some stocks are down, some stocks are up. If you have a long-term view, in my view, this is a dirt cheap company trading at EV over revenue of a 2.5. I dare you to find a lot of companies trading this cheap, even in the small cap realm. There's very few companies trading this cheap when they have 82% gross margin, when the business is very much like a SaaS business. I mean, sure, they have a physical product, these drugs that they ship, but these drugs are generic compounds. They are very inexpensive. They are shipped out of automated warehouses. The last call in Q1, the CEO announced even more automation, announced the arrival of quote-unquote robots, not quite humanoid robots, but more robots to help with the packing and the personalizing of the medication. So we have that going. The company is trading at 3 times gross profit, 2.1 times forward gross profit, and it's got an EV over gross profit or revenue growth. This is my spin on the PEG ratio of Peter Lynch, but I use gross profit as opposed to using earnings, because I think gross profit are a better indication of the value of a firm, I get a 0.07. Dirt cheap. The cheapest it's ever been, actually, for HIMS. This is the cheapest it's ever been for HIMS because they posted this quarter in Q1, the metrics were across the board between 10 and 12% better than Q4 of 2023. Across the board, they were more than 10% better. The stock stayed the same price. So if a stock stays the same price, but everything gets 10% better in a quarter, the stock got 10% cheaper. And this metric is going to calculate that, i.e. if Q2 is just as stellar as Q1, and if the stock is still trading in the $11 range at Q2, this ratio will get a 0 to a 0.06. And Q3, they keep performing this way. This ratio will get to a 0.05. So the stock at some point is going to have to move. And if the stock doesn't move, then you're just going to get an ever cheaper valuation, knowing that this is already the cheapest of cheap. Like, this is already the most undervalued thing I can find in the market. It's hard to find anything more undervalued. And so I'm very happy to buy this stock, very confident in this company. And now let me move on to my PayPal versus Shift4 conundrum a little bit, because this is a conundrum. So I have a tiny position in PayPal, very tiny, less than 0.5%. The point is, I entered my PayPal position a little bit ago in December, added a little bit in January too. I was hoping for a bounce back. Really, the whole point of why one would buy PayPal, in my view, is that you're hoping that it resets back to normal level, that it resets back to level in closer, more in line with, say, the ratios of the S&P 500. So really the reason to invest in PayPal, in my view, is multiple expansion, right? If you buy PayPal, you're hoping that the market will grant PayPal the multiple that it deserves. And that's kind of a risky bet to make, in my view, especially when I compare it to my favorite that I don't cover here, but my favorite stock in the payment space is StoneCo. I don't cover it in this video because I have a full position in StoneCo. StoneCo is over 5% in my portfolio. It's unwise to add more for this type of stock, especially, it's a Brazilian stock, a little riskier. So I want to look at, the payment space, because I love the payment space. The payment space is pure profits. It's a toll road. You are a toll road on the payment system. Buying into the payment space, if you buy in Shift4 or in PayPal, you're really buying the disruption of some Visa and some MasterCard, even though they use them as payment processor. You're part of that story of a disruption of cash. And you're part of a disruption of the established players in these payment companies. These are disrupting establishing players. And because I am big on, say, things like Bitcoin on this channel, which I've covered many times, I'm obviously very sensitive to this idea of investing in the payment business. It's the toll road. It's a toll road on the economy. It's a toll on the frequency of economic payments, right? The more people spend in a country, you just have this toll road where these companies, earn their take rate, their 2 to 3% take rate. It's really a great bet, say, on the economic recovery that I think we're going to see as the Fed drops rate. It's a great bet on this economy of abundance that I think we're going to have, where more and more people, more and more goods and services are going to be produced, which are going to be purchased by more and more people. And as a result of that, you're going to have more and more transactions. Anyways, back to the point here. What is my point? My point is the revenue growth for PayPal is plus 95% in 5 years. Not bad per se, but this is nothing stellar, right? This is this is better than the average S&P 500 firm, but this is nothing unheard of, right? Over 5 years, 5 years is quite a bit of time. And by the way, right there, you're barely catching up to monetary printing and to monetary inflation. Remember, why I bring up monetary printing and inflation is because of the name of the channel, right? Beat the denominator. I want my companies to take in their fair share of a new money supply PayPal got a little bit more than the money supply, but barely. They are roughly catching up. So that's why that tells me this is more of an expansion play, and really, I don't know when this will happen. This is a tenuous investment thesis, if you ask me, because the stock is still expensive at a 8.6. EV over revenue is 8.6, and it's not growing that fast. So with only 8% projected revenue growth, you can't have the growth to save you. But look at Shift4, which is what I'm doing is I'm swapping my PayPal into Shift4. Look at the growth of Shift4. So Shift4. This one is the right timeline. So Shift4 did a 3.3x in revenue since they went public. So in 3 years, a little 1 quarter over 3 years, they did a 3.3x in revenue, right? Going from 767 million to 2.5 billion. But look at the stock price. The stock price didn't do a 3.3x, but the stock price did a 1.7x. It should have done a 3.3x if assuming the EV over revenue stays constant. So in my view, we have a disconnect between the price here of a stock and the direction of the revenue. Granted, there is a little bit of that disconnect too in PayPal, which is why I had bought PayPal, because I thought this would catch back up. I do think there's a little bit of a disconnect too in PayPal, but in my view, when that gaps between revenue growth and stock price for both of these companies, when that gap goes away, in my view, that will lead in much more explosive growth of the stock price of Shift4 rather than PayPal. And so this is why I believe Shift4 is a much more compelling company. Not to mention, if you look PayPal on my usual metrics, right, and it was doing better when I first analyzed it, but if you look at PayPal on my usual metrics, it's a 2.7. That's like twice as expensive as a Tesla, right? Because my metric is very punitive to firms that do not grow very fast, right? 8% is not fast enough. And so 2.7 is really an expensive number on a growth adjusted basis. You're paying a lot for each percentage point of growth at PayPal. You're paying a lot for that growth, and you better hope they make the 8% and not 6%, because otherwise that's going to get even more expensive. So you're paying a lot for that growth for an EBITDA margin, which is okay, but which is the same as Shift4. That's the same as Shift over the past quarter. And if you add 8% growth plus that EBITDA, you don't even get a rule of 40. You get a 27. So you don't get a rule of 40. Of course, investing in any type of intangible business, you're going to want to see a rule of 40 of more than 40%, right? That's at least my style of investing. So PayPal doesn't fit that criteria. I was hoping for a reset, but it looks like it's not coming, and there's so many deals right now, and so I'm going to get rid of my PayPal position, looking at Shift4, looking at HIMS. So this was not investment advice. This is just entertainment, no financial advice. Hoping you were entertained. Please like, please subscribe. Thanks for watching, and have a wonderful day.